right. Good morning, everybody. So just to make sure everything is good, I'm using a different Zoom bot this morning. Zoom's trying to integrate their new AI companion, and I just want to make sure everything's good to go. You can see my screen, and I mean, I'm not going to ask if you can hear me because if you can't hear me, you wouldn't hear that question. So if somebody can just provide a little feedback, we'll be good to go. Let's try that. How about now? Yeah. Well, thank you, Andy. Hopefully you can see the screen too. Somebody said they couldn't, so just all right. Thank you, thank you. Hopefully that new AI companion on Zoom will be useful. I don't know. We'll find out later. So it's the day that we've been waiting for. I can kind of hear the old announcer, let's get ready to rumble. I'm not even going to try to reproduce that, but if I had echo buttons and a soundboard, oh man, I could have all kinds of fun with that. On the screen right now, what we're looking at is NVIDIA on top and Apple on bottom. This is from David Keller. He's this fantastic analyst that works at stockcharts.com. The guy's great. He's got, the Stock Charts has a free YouTube channel if you want to go check him out, but his Twitter is pretty interesting. From time to time, he'll post things. And this was posted as a part of the divergence between what's working and what's not. And, typically the fangs tend to work together and do what the others are doing. But you can see where things really started to fall apart here. They were both in a downtrend. They both started building a base and trying to come out of it. You look at the start of 2023, NVIDIA with just that really strong rip to the upside, and Apple as well, that strong rip to the upside. But then the divergence with Apple giving us those lower highs and NVIDIA giving us those higher highs. So we don't always know what to do with the information we get, but it's always useful to have the information. So this is something that stands out right now, how badly things are for Apple at the very least. So let's go ahead and get into it. We're green on the screen around the world. If we sort them by their worst or their down to up, Hong Kong is down the most, but less than 0.5%. So that's not really all that bad. And then that puts us right into the green. We immediately have basically the NASDAQ 100. Past that, the S&P 500, then the Dow, and then small caps. Now, between the Dow and the small caps, there is Japan at 0.5%, which is great. And farther down, we have the UK. Now, there was a decision today. There was a lot of news coming out of Europe today. I don't want to say it was a decision. The news today that was coming out is likely going to affect their decision. So they ended up with some data that calls into question whether or not they're going to get a rate hike, which was almost set in stone earlier in the week for Europe, that they were going to get a 25 basis point rate hike. And then suddenly things started to change. So we're likely to see a continuation of that news through the morning. Just keep in mind that our own FOMC is on the horizon today, and it's pretty well established at this point that they're not going to hike. Now, they could decide to come out and shock the markets. There's been times in history where they've done that, but I don't think so, right? I don't think they're going to raise. It's been, well grounded at this point that we're just going to pause. The main thing to be listening for during that announcement today is any kind of phrases about what we're going to do going forward, and I think that's really what the market's going to latch on to. We also have events today going on in New York. So there's a Microsoft event. There is an Amazon event. FedEx has earnings and General Mills has earnings. And those two might seem out of left field, like why even bother bringing those up? But they have a lot of impact on the market. Not their earnings per se, right? It's not like, oh, we hit, we missed, and then there goes the market. It's more about what they're going to say during their announcement about how they see things going forward. The things that they report and how they discuss their forward outlook is broadly accepted by the market, right? And not necessarily taken as gospel, but it is weighed heavily, and it will be important. So it got a lot of things on the table today. Now tonight, there's also, after our market closes and then we get into Globex, there'll be some data coming out of Japan. Always really important to keep your eye on what's going on over there. And if we look at, I had mentioned that there was news that had come out. There was a whole lot of speakers over in Europe, European central bankers and Bank of England speakers as well. We are getting crude oil inventories today. It's going to be another data point that is really big. Sometimes we look at those crude oil inventories, you just kind of shrug it off like, yeah, whatever. They're up a little, they're down a little. But a really big deal right now is the dot plots showing the increase in energy is going to kind of spread out like a ripple and affect things like inflation. So, if we're wanting lower inflation readings, we need lower energy readings. We're not going to get those, especially with any kind of spikes in energy that they can't control now because they don't have the petroleum to release from the Strategic Petroleum Fund. So there's a whole lot going on over on that side of the field. It's just a very chaotic month, and we're not done yet, right? So watch the clock today, 10:30, crude oil inventories. And of course, we've got the FOMC announcement coming in at 2, and then Powell going to come in at 2:30 and chip teeth, probably at least an hour, but he usually gets the worst of it out of the way within the first 4 questions from, the crowd. So the spot gamma implied 1-day move is 0.8 today. This is that level that when we get there, they're going to make a decision, do we monetize here or do we press it? If you look back over the S&P and the NASDAQ and we get around that 11:30 time frame, if we've been trending, running hard to the upside or running hard to the downside, this is usually where we pause and consolidate. And then they make that decision. We're going to flip it here and run it back, or we're just going to keep pressing the same direction. It generally ties in with this level here, or it generally ties in with my ADR red line. Either way. So it's 0.81 today. $10.32 and $2.30. It's interesting to note that we have more volume today than we did yesterday. even though today's the FOMC day. We had a reasonably decent IB right up until 8 o'clock. Nice sell-off. Then we ran back up and we had an inside day breakout, at least from the RTH point of view. We're still inside of yesterday's entire range, but we did break above the RTH high. And that is now where we continue to press. We don't have a missed daily pivot because we ran right through it. And we did break back inside the previous week's low. We also had that nice reversal with this 10-week moving average. Now, that first touch play yesterday was fantastic. Just coming down and getting into that 10 and then getting back up off of it. 5 or 6 points, with a couple of contracts. That's all I need. But the move down yesterday into that voodoo line was interesting. I didn't catch that one. I think it would have been a good one to catch, but I still have trust issues with the voodoo lines. The thing is, though, with those voodoo lines, at least you know where they are if you're using it, right? And obviously everybody doesn't have that indicator. This is one that is a paid indicator. I can't give it away. So you either have it or you don't. But for those who have it, it's not like we have to trade on that line, right? We can just use those lines for analysis, areas of interest, places where we could anticipate the price might react. And from that point of view, they do great, right? And I guess if you use them enough, you'll begin to trust them more. But it was a strong move yesterday to the downside. And the fact that we went as far through the 10 as we did was kind of impressive. I also did, just to be, transparent about things, in the Qs and in SPY, I started loading up into December and January call options, different expirations, different strikes. And generally I do that when I'm fishing around for, some good Greeks. One thing about the Greeks is they're not always easy to see or easy to read, but if you compare options in the same series, or just you compare your options to each other, your benefits usually stand out. It's kind of like trying to decide, what is it, the analogy I heard the other day? How does a realtor cost appraise your house? Well, the first thing they do is look at your neighbor's appraisal, right? Or the guy across the street. They look at what other houses are selling for in the neighborhood. When you're trying to figure out if the call option that you're buying is fair value, or yeah, I'm going to stick with that word, fair value, look around at the other calls, see how far off it is from its peers. So we'll see. That's a 10-week entanglement, right? We came down, got into it, came back out of it. And so far, it's a good start. The thing is, it could happen more than once. It could take a couple of weeks. If you look back here where we were getting tangled up in the 10, it took a while before we finally came out of it and began moving on. We've been entangled into this 10 for a while, though, so the anticipation is that we're on the other side of this at that point, right? That we're finally going to start coming out of it, and that we end the year at 52-week highs, and that's kind of what I'm putting my money on. That's what they say, right? Doesn't matter what you say, it just matters where you put your money. There's not a lot of hedging this morning. If there was, well, let me rephrase that, because that just popped up. We're starting to see some hedging. How's that? Live as we speak. So they are starting to bid up the front end. We know that. We can see that they're hedging because this implied volatility average is now higher than this average, which has activated the market maker move. It's still minor at this point. It's just barely there at all, but you can keep track of that as the morning wears on and see how it just turned back off again. It's so minor at this point that it's literally flickering and it hasn't decided how bad it's going to be. So they're beginning to hedge. It's interesting to know. 10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. And when we're at the lows, we expect to go to the highs. I always love it when it's a day like this and it just looks fantastic, as if we went literally from that high down to this low. Isn't that awesome? It almost looks like we went down there and bounced off of that level and came back up. And I continue to point this out because that's not what happened. If you go back to yesterday's morning briefing and you look at where the low was then and look at the levels on the volume profile. Okay, so when price went down there and turned around and then came back up, that became the low. So it didn't go down and hit that low and bounce off of it and drive higher from it. After price turned around and came back up, that low was now there and the line was set. Again, if you struggle with this concept, one of the things that you can do to really help with that is that every single day for a week or 2 weeks, 3 weeks, every single day at a certain time, like 7:30, take a picture. Take a picture Monday at 6:30, Tuesday at 6:30, Wednesday, and you'll start to see that the changes, they'll bring all of this together for you in your mind when you're using a multi-day volume profile. All right, so you can see we are right now escaping from the 70% volume profile. Between the yellow area is the one standard deviation, so 69 point blah, blah, blah. We just round up and say 70%. We're outside of that. We're in the 30, but we're already bringing the volume up. So while we haven't spent, a massive amount of time up here, you could see the amount of volume that we have up there was pretty significant. Usually on a morning like this, I like to ask questions, like, did we hit a ceiling or an iceberg? There's an indicator called a TPO. And this TPO looks very much like a volume profile, but it's not a volume profile. We want to set it to a day. We want it on expansion, so it's only doing today. Profiles won't matter because since it's on the right, there's only going to be one. And we'll set this to tick size so that it's a little smaller in shape. See if we got it. Yeah, we got it. So TPO is volume by time rather than volume profile, which is volume by price. Okay, TPO, time, price, opportunity, TPO. The reason I turned this on is I really wanted to be able to answer the question about this volume here. When we have a large amount of volume, it stands to reason that we spent a goodly amount of time there. And that's what we're seeing. What would have been interesting is if it was a shallow area like that right there, and it was still had all of this volume there at the same time, because that would have implied that we hit a ceiling or an iceberg or a block order, or that there was just this massive amount of volume that had been sitting up there waiting. And that even though we didn't spend very much time, which is what that would have implied, we didn't spend much time there, that we did have a lot of volume there. So nothing to see here. It did have the volume shape by time and by price, but it didn't hurt to look, right? It's kind of the whole point of having tools that we can use, is being able to use them. So like nothing to see here. We do still have every expectation that we're going to maintain the range into FOMC, but I will stress caution with this. Europe sounded pretty happy this morning. They were, animal spirits kind of thing, right? They were really jolly, chatty, exuberant in most of their interviews that they were doing. And that can bleed over until at least 10:30, right? When we start seeing the close of the EU and the markets are just us again. So kind of keep your eye on that slow grind or that bleed higher, at least up into yesterday's highs, right? We're already outside of the RTH high, but then we've got that Globex zone and that Globex high. And we are at the roundy 4,500. This is usually a line in the sand where we say if they're going to make a change, it would be here. That's absolutely true. If they're going to dump it, they'll do it from here. So kind of keep that in mind. I guess you could say if we get above that 4,500, we can go to 4,510. Maybe might as well say the cog line 4,511. And then it'd be wait and see for FOMC. Man, that's almost like a rhyme. All right, on the week, if you consider where we closed on Friday at 4,500 and then where we are right now at 4,500, it's like the hamster on the wheel, just doing a whole bunch of running around and he hasn't got anywhere. Isn't that fantastic? So this is a lot like probably how the trades have gone this week. You know, if you were trying to trade in the FANGs or in the financials, that, you know, 80% of the market does what the S&P does. And if the S&P hasn't gone anywhere in 3 days, then probably everything else hasn't either. This is why we say it's just sometimes better to take the week off. And I do know a lot of traders who take the week off during FOMC. You know, recharge your batteries and refill your mental capacity, your mental bank. So the lines on this 45.54 and 44.43, that's the week's range. If things were to get wild and out of control, then we could break that range and start to expand. But we really don't have the expectation that we're going to do such a thing. So if we turn on something like the SPX, where I've got more levels, and we reevaluate, see if I have them all. No, I can't use that one yet. I'm working on a new line series. Here's some old FOMC events, right? And you can do this with CPI and PPI, non-farm payrolls. It helps when you're doing a left to right analysis, right? And you kind of walk through the different things that we have out there, right? Like if this was maybe a little bit wider of a chart, say 3 years, and we added a narrative to it, right? That July high of last year when we hit the 200 period moving average, and the entire market was all focused on hitting that 200 period moving average. And then the head and shoulders behind it, the Jackson Hole, screw you, suck it up market, higher for longer Powell speech where he dumped the market, the Bank of Japan bailout, right? Or excuse me, not bailout, intervention. You know, that can't forget that one, right? That brought us up off of the lows. Or the March bank bailout, the AI explosion, right? Every one of these has an event to it. And it's that narrative that carried us for a quarter, maybe a little more than a quarter. And then there's another narrative and it carries us again. So putting together some chart like this, where you can annotate the events that cause significant changes to market structure, then when you're doing your left to right analysis, you walk yourself up to the current event's current location. Look at some of these FOMC moves. FOMC would be the white line. And think about how the week ended, you know, outside the box or inside the box. So back here, we had FOMC. And it was a fantastic blowout move. Look at the middle line, right? It was almost just like today, if you think about it. They ended their week at 40.67. By Wednesday during the morning session, where did we open? Right on the line, just like today, no different. And they managed to go completely outside of the box and back in again by the end of the day. And then follow through on Thursday, back and close in at the end of the week on Friday. Maybe I cherry picked that, right? So here's another one, FOMC again, this time to the downside. The thing is, we were pretty weak here already from where we started the week and how far we had already bled down, but we still managed to close inside the week because we close inside that box, 80% of the time. Something to think about. So today, with the FOMC, the expectation is we're going to get a little violent. We're going to whip about in both directions, but then at the end of it all, we're not going to be that far changed from where we are right now. And as long as you can hold on to that concept, that the end of the week, maybe, today we might end higher or lower, but by the end of the week, we might not be that much farther away than we are now. That's kind of the big takeaway, right? And there are, by the way, if you search on Google, especially Google Scholar, which is a different Google, you will find fantastic research papers on events and events on markets, including FOMC, with some great stats behind it too. For free, likely you might find some that aren't, but there's plenty that are. So you shouldn't have to pay for it. Yeah, you haven't heard of Google Scholar? Oh man, we use that in college all the time. I mean, nowadays, if you have the right AI bot, you can just ask the bot, you just got to give it the data first. But all right. So to be fair, there's really not a whole lot of reasons to dig down into the equities that are up or the equities that are down this morning. So we'll touch on them briefly, but on a day like this, trying to dig through the sectors or the industries that are up for a move would be very likely a colossal waste of time. Everything is going to come down to FOMC, and it's very likely that the only thing that's going to make some really good moves this morning are penny stocks. And that's because they are event driven anyways, and there's always events. I see a couple of penny stocks on the move this morning that seem to be continuations from yesterday. AVGR, for an example, and HSTO isn't from yesterday, but that AVGR is. So US dollar Japan, we got above that 148 and was instantly smacked down again. But if we look at it on the higher time frame, it's still just bullish. It looks bullish, it feels bullish, it's acting bullish. So it's really going to come down to, are they going to wait for that thing to actually pop and start making its move towards the 152, or are they going to intervene, be preemptive, and smack it down before it even gets there? And will they coordinate that globally or not? Because when they intervened back in October of last year, right, when Bank of Japan intervened on that October low, they didn't do it alone. They had global participation in that intervention. And we are getting the continued sell-off in the dollar, which is nice, the Dixie. Nice and easy, no fast, sudden moves. We got above that 105 and a half. Like, I don't think we actually made it to the half, but we got pretty close to 105 and a half. So getting it back down to 105 is not bad, but it needs to continue to sell off, right? We want that thing really back below 103 would be great, but just a little at a time. The fact that it's not advancing is a good start. And then the 10-year still above that 4.3, 4.33, 4.35. Yesterday it was into 4.36. I know that might sound like just minor little things, but this needs to back off. It needs to calm down and back away from that high. Nice and easy, and needs to keep it. That little bit of a sell-off, that wasn't enough, right? You gotta remember how we closed Friday, and then on Sunday night, it popped up high, and that fade was more mean reversion than anything else. And with the EIA crude oil inventories today, you can watch CL or maybe USO. This is a market with a whole lot of nothing, just holding his breath. Everything in the middle of a range. All right, so here we got the fangs, little 8 grid. One of the things that I've been watching is Netflix with this really tight consolidation down here. That thing's ready to make a move. So I'm watching Netflix close because we talk about names that can run. Oh man, Netflix can run, right? It's one of those that just, it can get back up into 430 and 440 in a day. I'm telling you, this thing is just fantastic mover. And now it's got an average daily range of less than $12. So if we're talking about being under 400 here and getting to 420 and 430 in a day, I'm telling you, it can do it. But it would be a 2 or a 3 standard deviation move if we start getting too far out there. Still, Netflix is one of them. The more we stay compressed down here, the more energy it's building up. And these really tight, really small candles after such a fantastic drop are something I'm watching close. This thing is poised for a play. And you don't want to wait until it's actually hitting your scanners, because your scanners, when they finally tell you that it's moving, are going to be too late. You want to be watching this thing close. So I've got a chart up on it in one of my screens, and it's the only thing on that screen because I'm watching it close. This one is going to be hopefully a nice move. So out of all of these, it's the one that I like the best. The way that Apple closed yesterday inside that previous day, this now puts us in an IX10 as we opened this morning, because if you look at where we're at 178.70-ish. So we're still inside of September 18's candle. That makes us IX10. If we get this breakout above the island here, then we'll aim for this gap close. Right now we've got a gap down where we built this island, and we need to get that gap. That'll start to put us into a move back into the 190s, and back up into, I think that's 52-week highs. I'd have to go out and look, but either way, that's a nice place to be. And it's all going to start with first breaking out of yesterday's range or breaking out of Monday's range, then getting out of this island that we're in, and then getting that gap closed and getting above it. One step at a time. So between Netflix and Apple, those are my favorites. We do have the same island that we have in Apple in Tesla, but it's the other way around. Tesla had the gap up, it built the island here, and the low on Tesla is that 260.61. If we break that low, then we'll attempt to close the gap. And to close that gap, we'd have to go to 248.5. Now, some analysts will say if we get inside of this bar at all, the gap is closed. To each their own, that's just not how I do it. As far as I'm concerned, if we closed there and we opened way up here, then to get the gap closed, we have to go back down to where the market had closed. I mean, that's just the way it is. That's the way that I do an analysis on a gap. So 248.5, nice round number. It's easy and it's clean. For Tesla, that would be the gap close. Now, there's a lot of gaps on Tesla that need to be closed, right? Including the one overhead at that 274-ish, right? Whatever that happens to be up there, 274.39. So that's another gap, but that's a gap for another day if we continue to go down. It's really what we're priming up for. If you look at where we closed and you look at where we're at in the pre-market, we're actually up a little bit. But one of the things that I was listening to this morning in the news is that there's more rumblings of Musk getting sued, or maybe it was just Tesla, but there's some more negative press coming, say it that way, which would kind of feed into the narrative of a downward move here. Getting to 248.5 would be a good start. It is interesting with Microsoft. It has that New York event today. It's all day long. These red candles are hollow. And what I'm using is Thinkorswim's trend candle patterns. What it does is it changes the color of the candles on this hollow or not based on whether they opened and closed correctly. So my green candles are hollow if we opened low and closed high. And my green candles are solid if we opened high and closed low, but still closed higher than the previous close. Okay, that makes sense. With the red candles, they're filled in if we opened high and closed low, and they're hollow if we opened low, closed high, but still closed lower than the previous close. I know when I say it fast, it sounds confusing, but I promise it's not, especially if you've been using it for a few years. Like, this is my default chart setup, so I use it. The thing is, what I'm getting to here is that Microsoft has gapped lower and has been falling lower since Friday, right? Friday had the big sell-off day, and then Monday and Tuesday. The difference between Monday, Tuesday, and Friday is that on Monday and Tuesday, we gapped lower and closed higher. We gapped lower again and we closed higher again. So there is buying going on down there. They are defending that low. They're just not able to get any follow through. But with the investor event today, I shouldn't call it an investor event. With the event today in New York, it might get that push that it needs, right? A lot of times it's no more than just social media and getting enough eyeballs on it that people want to come in and buy it, right? Maybe it's the noob, the new guy wave, right? So either way, Microsoft is worth watching today in case it actually starts to get that push. So one of the levels of concern is going to be 333.5. And again, that's just a nice round number. Sometimes things just work that way. So 333.5. If we can get through that, that'd be Friday's midpoint. Then we can challenge 337.5 and get back up to that 340. Now, I'm telling you, we can do that in a day, no problem. We could go from our close at 326 to 340 today, no problem. It's not likely to do that, right? Let's just kind of add to the point that that's not, likely. But look at the ADR, it's $5.50. Add the market maker move, creative license, it's $4.50. Combined, that's $10 right there. And that's the normal move. Well, we know in it, when things get wild, they can easily double their normal move. So if the normal move is 10 and we double that to 20, we can go from 326 to 346, and it would still just be another walk in the park for Microsoft. Nothing really exciting about Google sitting in the middle of that zone or that range. Until it gets out of that, I'm not overly excited about it. And if you look at Meta, we just came up to that 50% mark, right? That's Friday's big day. And we got tangled up at the 305.38 area, that 50% mark, which makes sense because if we were going to get tangled up into anything, that's very likely what we were going to do it at. So now we're primed with a little bit of a make or break. We closed at 305.07 and we're down to 304.72. So we're off of that high a little. Let's see if they got the push to take this from, if we fade down to Monday's high, get a nice bounce on 303.5, retest the 305 breakthrough and get to 312 by the end of the day. All of this is implying that we're going to have a bullish outcome to FOMC. I don't know why I think that we're going to have that, but all of this work feels really bullish, right? Now, some analysts are just perma bears by nature. They just live there. Everything that they look at is all bearish. Maybe my bias is bleeding through a little bit, and I'm looking at these in a bullish way. But the thing is, until they trigger the trade, it doesn't matter, right? Because if I'm wrong, they'll never trigger the trade, and then there's no long play. Just about as you would expect when we're looking at what's up and what's down this morning. Most things are below our benchmark of 0.5%. Jets are up just enough, and so is real estate. But that's it. Jets and real estate. That's not enough, right? But if you're looking for a day trade into anything while you're waiting, at least you'd have those, right? Bitcoin's down, but not enough to be down for our metrics. And nat gas is down still. Talk about, building a base. Old nat gas has been there forever, and it's still not pushed through. This was everybody had eyeballs on nat gas earlier in the year. We were all kind of hung up on the idea that this was going to quit falling eventually and start turning around. The thing is, with if you want to go look at some Wyckoff charts and get into accumulation and distribution, and building this base can last anywhere from 1 week to 1 year and then some, right? There's no time frame on it. Eventually, when people quit looking at it and it's forgotten by everybody, it's gonna run back up again. But there's a long ways to go. And if you want to help yourself a little bit, right? We always talk about correlated markets. Never trade alone. Look at your peers. Look at your industry, sector, subsector. There is a spot, a futures index for nat gas. Let's see what it is. I mess with it every day. We'll look at it on TradingView if we have to, but I had it over here. Let's just go here. There is a nat gas futures, and you can use that. The prices aren't going to match, just like, say, SPY doesn't match the ES in their prices, but it'll still give you that sense that you have something else to look at. Bring it up on TradingView. Yeah, I just had it backwards. XNG USD. So again, the dollar values won't match. But you can see how we're getting near that breakout point. We've been getting these higher lows and equal highs. And you know, if you're trading with that, if you're doing an evaluation account or, you know, whatever they call them at the prop firms, I don't want to name any of the firms, but if you're doing one of those accounts, trading something that's a little less volatile, that has a much cleaner order flow so that you can use Bookmap or Jigsaw or something like that, you know, kind of broaden your horizon a little bit so that it's not just NASDAQ and S&P. There's a lot of great things out there to trade. Oil, gold, precious metals, the FX markets. The whole idea is, you know, to trade something with consistency. So if your order flow is consistent and it's not just jumping around all over the place, then it's easier to read. It's easier to use order flow in your trading. There's something to think about. Interestingly enough, someone has requested that I get through that and help them get through that. So that could be a new series coming out on, you know, trade strategies and setups that deal with that trailing stop system that those prop firms use. I don't care. It's not my thing. I don't trade with I trade with my own money, but showing how to get a funded account, yeah, why not? That'd be a good series to help people out. Yeah, let's go take a look at NVIDIA. So NVIDIA is trying to get back here a little bit. Let's compare this. So here on the right, I've got the ES, and we're literally breaking out and pushing higher. And here on NVIDIA, we gapped down in a liquidity gap, and then we spent the morning trying to get back up there and get it closed. And it's still struggling to get it closed, right? I'd say it's not closed yet. It needs a little bit more. But that's really the only reason it seems to have come back up again, is just trying to close that liquidity gap. That's a pretty significant drop to the downside. So we've got NVIDIA there. Compare it with, say, AMD. It had a similar gap down, but not nearly as bad. And AMD's already back up through the gap on the other side and kind of pushing with the markets. Or Intel, nearly no gap compared to NVIDIA. Still underneath the whole thing, but it doesn't look so bad, right? So let's see, TSM. Yeah, no comparison. Or semiconductors with the SMH, basically just some algo pumps there. So NVIDIA took a significant gut punch here, and that liquidity gap needs closed. It's odd to see it struggling so much. You know, if everybody loved it, then where are they at now? We closed at 435.20. We're at 434.40, so down a little bit. If we're going to see this thing get through today, we got to first get through the close of yesterday and then the open. And then we'll focus on Monday's close, which is Tuesday's high. Isn't that fantastic how pivot points just line up like that? And then we'll focus on Monday's high. Now, if you're wondering, why didn't I cover it when we were in this big grid? I talked about these others. Why didn't I talk about NVIDIA? The reason I didn't talk about it is because it had a junk chart with no signal worth focusing on. If it had a signal worth focusing on, I would have focused on it, but that doesn't mean it can't be traded, right? It's just that it doesn't have anything. So what we can say is that it's IX10 at this point. We'll be on day 3, range bound inside of this big blue bar or green bar on most platforms. And that even if we do get a breakout to the upside, we're still going to have to get through the September 15 candle, right? That's kind of our line in the sand. Notice when we measure that bar, by the way, how far we went on the next bar. 100% of the measured move. I'm telling you, you couldn't make that stuff up even if you wanted to. It just works, right? It just works, and we don't know why it works. I'm partial to the downside on this because of the way that it has struggled to get that gap closed. And with that in mind, instead of measuring that red bar, because we don't really need it anymore, and instead we measure this blue bar here, there's a couple of things that come to mind. One is the 50% mark. So let's get this back to an intraday status so we can see both. 431.20 is a little bit of the line in the sand. We interacted with it yesterday, which makes perfect sense, right? That's why we use these measured moves. The fall yesterday ended around 50%, a little bit of overshoot. We came back up. Now we've got to get down there and we've got to keep it with conviction. So that's your first trigger. You don't even have to wait for it to break yesterday's low or this morning's Globex for your opportunity. I would say if we get below that 50% mark, say on a 15-minute time frame, you could use a 30 or a 1 hour. I'm not, biased against any chart time frame you want, but we need to get below that level with enough conviction that you're ready to go short. That would be a great trigger. Now, I am a big fan of low risk entries, and that would be trying to go short before it ever gets down there, right? Somewhere in this zone. The thing is, you would be going short before you have any signal to go short, which will offer you great trade opportunities, right? Buying puts when we're still going up is the best puts that you could buy. And getting in short across those highs would give you the least risk per trade. But as a strategy, you're doing that without any signal to go short, no confirmation to go short. And if you look at only your win rate, you will lose more often when you trade without a signal to go, but your losses are smaller. And for me, it's not about winning and losing. That's what we do in sports. I don't care about winning and losing. I care about making money. So if you get a chance to short the highs, I'd short it from that box. If we get there and we don't fall there, then the short would be against these highs. And if we get there and we make it through, then you kind of got to abandon the short idea at that point. Now, the thing is, you can still short the highs without waiting, quote, for confirmation. You don't have to wait for it to break all the way down here just to get confirmation, right? You can wait for it to do something like that. It ran up, it got entangled into that zone, and then it left that zone to the downside. And that could be all you need to short from the highs, right? There's no reason to get it right at the top or as soon as we get into the red box that you try to short it. You could just let it prove that that resistance is holding and come out of that box and then get your short. You would still get the benefit of all of this. And if we do get down below that low and you're already in it, when all the latecomers come piling in and push it lower, you're already in it, just taking it for a ride. So that's what I would focus on for a short opportunity, is shorting it off of one of those zones. And if it doesn't go up enough to get into one of those zones, then short below 50, short below yesterday's low, and or short below the Globex low, either of those three. I would ask though, right? Like we all get fixated on different things. And I know some traders who will just trade one market day after day after day. And that's, none of that is wrong, right? There's some really great AMD traders out there, some great Tesla traders out there. out of everything out there that we have to trade, is NVIDIA the best product to trade, right? That's a question I ask myself all the time when I'm getting ready to take a trade in anything, X-Steel, USO, NVIDIA, Apple, whatever I go to trade. I always ask that question. You know, what am I trying to do here, long or short? Is this what the rest of the indexes are doing? Yes or no? And then is there anything else that I could trade besides this that might be a better trade, whether better options, better chart, you know, better return on my investment, anything else that I can do? And if the answer is no, okay, I'm going to take this trade then. Just throwing that out there. If NVIDIA, you know, is really the greatest thing that we've looked at out of all these charts. I'm up here, guys. Be careful, be safe, have a good day, and I will see all of you tomorrow.